Tesla has been ordered to stop preparing its Gigafactory in Germany on Sunday. It comes after environmentalists won a temporary court injunction against the electric car maker. The factory is scheduled to open in 2021. Now, joining me today to discuss how to trade the stock using options is Serge Berger from thesteadytrader.com. Serge, good to see you as always. Now, when we used to talk about Tesla, we used to talk about the fact that there was this real pull between the bulls and the bears, but lately it really appears as though the bulls are firmly in the driving seat. I mean, do you have a directional view on Tesla firstly before we get into that options trade?
Hey, Victoria, I think it's not only impossible but very dangerous to really have a directional view from a trading perspective on Tesla just because of its volatility. So I prefer to do more of a non-directional kind of idea on this stock for the time being.
And that's kind of one of the really interesting things about options, is that you don't have to take a directional view in order to place a trade. The idea is actually you're playing a game around volatility. Are you looking for volatility to rise, or are you looking for it to fall? So talk to us about your trade on Tesla, because it sounds very interesting.
Yeah, so I mean, this is, I'm going to call it a quasi non-directional trade. It's not a purely non-directional trade, but it's quite frankly, in my opinion, the only way one can trade this stock right now, my personal opinion. So if you look at the chart here, I mean, I think everyone's probably heard about this. It's basically gone parabolic is the only way to put it. It's really quite comical in terms of how much it's overbought. And the daily chart, the weekly chart, it's completely nuts. I'll quickly give you this on the weekly chart. And you're starting to see some real exhaustion candles just telling us that there's plenty of overhead supply or lack of buying interest somewhere north of the $900 area, maybe a little bit lower. So in my opinion, again, doing a non-directional trade here, I like to make a bet that instead of the stock, let's say, having to go lower for a bearish bet or having to go higher for a bullish bet, I like to make the bet that I don't think that the stock over the next few weeks is going to go all the way up to $1,000. So that is a much higher probability, because what we can do is we can make money whether the stock goes sideways, whether it goes lower, of course, and even if it goes against us to a degree. Now, if you hold it all the way to expiration and the stock does not go above 1,000, the stock can still go against you by 25%, which is crazy. So you can be completely wrong, like literally 100% wrong, and you can still make money. So very specific, what I'm looking to do, I'm looking to sell a May expiration, 1,000 strike call, and against that a 1,010 strike call. I'm looking to receive, as of right now, we can receive about $2 of net credit for that. So that's basically $200 for the 100 shares of stocks that one option contract represents or controls. And what I'm looking to do is I'm looking to get to keep about half of that. So if the stock goes sideways or lower within the next 3 weeks, I will get out and take profits if I get to keep 100 of those $200 per options contracts. Now, in terms of stop loss, it's important to have both a time stop and a sort of quantitative stop in terms of the numbers. So I don't think we want to hold this trade open for more than 3 weeks. It's one of the main reasons we're using May options, because to give us an extra buffer, but also if the stock goes against you so much that the options spread costs you $4 to close it, right? So basically, if you take a $200 loss, that's where we would get out from a quantitative perspective.
Okay, so can you just give us a bit of clarity around the risk reward around this trade?
So the reward to risk is probably not the way to think about this, but basically what you're doing, and this is always very tricky about credit spreads, you're technically risking 1,000. I'm sorry, technically risking 800 to make 200, but that's not actually really the way to think about this, because you can make money whether the stock goes sideways, lower, or against you. So reward to risk isn't really the right metrics to think about this, because you have more than a 2/3 chance of making money right out of the bat. So basically, the way I try to I trade options for the past 20 years, not so much to think about how much money can I make, but what's the probability of making a profit, period. Right? Because that's the whole point, is making a profit. And that's really why I like to do these credit spreads, particularly in a name like Tesla.
And what about if it looks as though the trade is going against you? Obviously, you wouldn't want to hold it until expiry. What kind of levels would you be looking to get out at?
Yeah, so that's why I think it's difficult to say exactly what level, but because we have to have both a time stop and a quantitative stop. But I think at this point, just to give you a hard line in the sand, just regardless, I don't think if this stock goes much above the high 800s, maybe 900, you should really be in it anymore. But again, at that point, you're probably at the point where it costs you $4 to close the trade anyway. But one of the reasons we structure the trade we do, which is to say we go way out in time. I mean, it's February right now. We're using May options, and we're going 25% out of the money, right? So this stock can technically go 25% against. That's a huge buffer, right? Even for Tesla, it's a pretty big buffer, and Tesla's a crazy stock. So both they're going way out in time, but only holding the trade for 2 to 3 weeks as a time stop, and that's the real key. And going way out of the money is really kind of our sort of 1-2 step sort of risk management process, if you will.
Yeah, so can you just give us some insight into how you kind of come about with those parameters, particularly when I'm thinking about the May expiry? Why did you decide to go for that month?
I decided to go that month because I generally try to sell options between 40 on the lower end to 70, maybe sometimes 80 days out. That's where I found I get the most reward to risk in that sense, even though the reward to risk is reverse in this kind of trade. And I try to get about a $1 net credit for a $5 wide spread. Here we're talking about a $10 wide spread, so we have to get $2. So that's kind of my metrics I like to go for.
All right, Serge, thank you so much for your time.
Thank you.
That was Serge Berger from thesteadytrader.com talking us through his options trade around Tesla. I'm Victoria Scholar, and thanks for watching IGTV.